Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Hello, Jim.
Danielle, do today's financial markets resemble the setup for the 2000 dot-com crash?
Yeah, in some ways we're worse. I would say in the ubiquitous nature of the manias and the overvaluations that are sweeping the land in every asset class, we're far above the risk parameter that we saw in the tech sector in 2000. At that point it was really mainly concentrated in technology companies and anyone that put .com on their name. But you also saw, even though that sector collapsed 80% in general, like the NASDAQ average, the other companies, the more, the pipelines, the banks, the more, conservative, so to speak, sectors of the stock market still lost half their value as well at that point. Because when you get a bubble bursting like that, it takes oxygen from everything else, and forced selling, really cascades across the other asset classes. So you saw a big sell-off in everything. The difference, I think, that makes this time much more serious or dangerous is the fact that we also have this mammoth housing bubble at the same time. Back in 2000, really, we hadn't had a great deal of movement in housing prices since the peak in the late 80s. We had that was when we had a big drop in housing prices in Canada, and then things really were sort of stagnant for about a decade coming into 2000, and it wasn't until the 2008 crisis that we really saw Canadian housing take off again. So now that we've had this massive balloon in the valuations of Canada's housing at the same time, I think we're really that much more exposed to a bursting of these bubbles, which could potentially become simultaneous, as that's how they tend to go, and sort of evaporate liquidity across the economy. So it's a pretty precarious mix for sure.
Yes. Now, with the Canadian bubble, friend of the show, Ross Kay, says prices have actually been going down the last 4 months, but the Real Estate Association does tell you that. They say prices are up, but he said that's only because first-time buyers are out of the market and only high-end homes are selling, so that bumps up the average price. But he said in real terms, housing prices have already been falling the last 4 months. What's a Canadian to do if you're looking at buying a home? Do you hold off or...
Well, it's a complex question, and it really comes down to the individual's financial circumstances, their life circumstances. I think if you're someone who finds a property that you can see yourself staying in for a decade or longer and you can comfortably afford, that you have, a large down payment or hopefully can pay for to a large degree, don't have to take on a huge mortgage, don't have to bank on interest rates staying below 2% on that mortgage in order to make your ends meet. I think if you can find a place with those parameters and expectations, then you're probably still okay. But if you can't, if you're reaching to buy something just because you're afraid that the prices are going to go up further and you're not going to be able to get into anything, and you do have to highly lever, and you do think that you may not want to stay there for more than a few years, I think those are all kind of warning flags that you should probably not make that leap then, because it really magnifies your financial exposure to the potential losses. And the other thing is that just a decline of 20%, which wouldn't be which would be highly normal, actually, not even above average, coming off of the fact that we've that we doubled home prices in Canada and many areas over the last 4 years. So just that basic correction of 20% would be enough to wipe out the equity of many of the people who have bought in recent years, and it would be enough to spike the defaults on mortgages, drive forced sales in the market. So I think that's the thing people miss. It's not that everybody would lose their home, but it's at the margin, the people who came in highly levered and late, who are, in many cases, there's been a lot of this data taken in surveys and reported through the government sites, but basically anyone who's paying more than a third of their money just to keep the roof over their head, and a lot of Canadians are paying more than 50%. And there was that report that came out this week from I put it on the blog, just reporting how of all the major. It was from UBS. They do this report each year, and they look at affordability metrics in major markets around the world, and they found that Toronto had the highest bubble score up there with Frankfurt. So 2.02 for Toronto, Frankfurt 2.16 on the bubble metric risk. And Vancouver actually was in the top 6, but considerably behind Toronto now at 1.66. So definitely the area that I live has kind of been the epicenter this time of the panicked movement of all that population that's concentrated in the metro area, moving an hour north and south and west from that epicenter in the Toronto area. I know it's happened around other cities as well, and certainly all around the Great Lakes. It's been a common theme the past for the first year of the pandemic. But that's where we really see these grotesque prices now, and I think those are the areas that are the most vulnerable. And the other thing is that, as I've mentioned before, because our economy has become so focused on its economic growth from the housing sector, just like China did as well, and there's some parallels there, as I've mentioned before in Sam Cooper's work, Willful Blindness, that looks at the interconnections between the Chinese and property market, the Communist Party, the drug trade, the casinos, money laundering, and Canadian realty prices. But anyway, there's a lot of tentacles there. But basically, whenever you do see a decline of even just, as I say, any amount, even a 10 to 20% decline would be very difficult to absorb for many households. And those type of declines, any downturn in real estate, typically bring the deepest, longest recessions. That's always been the pattern historically. So, when you've got all these international think tanks and analysts and economists looking at the data and saying that, Canada has 2 of the worst cities in the world for the bubble risk, that's a pretty sobering stat.
Does the work from home metric play into this? And will offices once again be packed with workers, or is that something of the past?
Well, even now that, we have a very high percentage of people vaccinated, certainly in Canada, it's about 74% have a double vaccination. And in many other cities, it's a high level of vaccination as well in the United States. But you still see that the vacancy rates are still very high in many of the commercial buildings in the hubs of the center. So I think in some ways this is a durable change. I don't mean that we'll always work 100% from home or anything, but I do think that there's been a catalyst shift here to the way people perceive what's the best optimal arrangement for their work-life balance, and also for companies to figure out, we don't necessarily need to maintain this much overhead in these very pricey markets to house people, and we can come up with more flexible and cost-effective ways of having people work. So certainly, if you can work from your home and you can equip it to do so, there's some additional value there for the worker if you're saving on commuting and that sort of thing. But again, it goes back to how much of your income is being taken just to maintain that roof. And I don't just mean in mortgage payments, of course. You have to also say utilities and taxes and maintenance, which, as you know, as a homeowner is significant. So all those factors really just make a lot of question marks upon to what degree we will see a correction or a downturn in this sector. And even if we saw flat growth, I would submit to you, over the next few years. I mean, no bubble has ever deflated by just going flat for a decade. First of all, it has a big sell-off, and then it typically doesn't recover for a number of years. But even if you didn't have a big burst, if you just had sideways for a decade, I think that would be extremely disappointing for many of the people who have bought in so high. Again, rents have not kept up at all. Rents and incomes are the two weights that bring price back down over time, because ultimately it's uneconomical if your income doesn't service your maintenance costs, and also if you're trying to rent it out as a investment property and your rents are insufficient to cover your costs, then it's a negative carry asset. And we've seen that in other countries like New Zealand and Australia for similar factors, ironically, as what's driven us to this bubble proportion. The incidence of homelessness is also going off the charts, because a lot of people that are, trying to maintain just basic housing in and around city centers have had a very difficult time. And the gentrification, when all of the free money and cheap credit and investor capital is interested in trying to build towers and, the most expensive type of housing for the highest level of profit, you get a misallocation of resources, so that you get too much of that type of supply and not enough of the actual working person housing which they can afford. And that's what we keep seeing in places like Vancouver and in and around Toronto, and certainly in other high areas as well.
Sure. The Burnaby Metrotown area, a prime example of that. All the 3-story wooden walk-up apartments have been bulldozed, and they were mostly occupied by, again, service workers and pensioners. They have luxury towers.
Yeah. And the number of vacancies, there's been studies done on that recently too, and Canada has a significantly high level of these properties sitting vacant, which ultimately is not good for any of the business or commercial interests in and around the downtown area, because they aren't the patrons. There's not the walking traffic, the people living there that support the local businesses. So again, it's just a very unproductive use of capital. I saw a very interesting chart from China's statistics, because we were talking about the Evergrande fiasco and how that's spreading to other property developers there, with the crackdown on excessive leverage in that sector, and how that's turned the Chinese economy down, and how we're seeing a influx of insolvency crisis that's going through that particular banking sector right now. But basically, an interesting stat was that the number of Chinese people who bought second and third properties in the past few years is very high. And these are properties that they can't afford to live in themselves, and actually no one can afford to rent, and they've only purchased them because they could have access to credit, and they are hoping that it is an ever-escalating asset. So in other words, it is not an investment thesis. It's a speculative gambling thing. And they've done this, which overextends them ultimately. And then for the same reasons, empty properties are inefficient and not supportive of the local economy in any way. So and then the other thing that's happened, of course, which is similar to what happened in 2008, is that the local governments, only worse, much worse now than then, but local governments become very dependent on revenue flow from transactions, right? And tax, land transfer tax and that sort of thing. And so again, when the prices roll over or the boil comes off, which it seems to be doing now, as you mentioned at the outset, when the transaction volume begins to decline, you have big holes left in the budgets of the governments that were relying on this revenue as well. So it really hits at a bunch of levels all at once. It makes us very undiversified and risk exposed, and that's not a good thing.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, how long is this supply chain crisis going to last?
Well, it's a good question. I think that it is likely to end sooner than people think. And the reason I've been saying that is that just the growth rate in consumer durable goods orders, the new orders that were put in the first year of the pandemic from, say, March 20 to March 21, there was a 40% leap in the amount of new consumer good durable orders. And since March of 21, we've had an annualized decline of about 8% in new orders. So what went, again, these really hyperbolic moves to the upside, which were driven by, subsidies and panic over where one was going to live and people buying online and all this sort of thing, retrofitting their homes. All of that really, the leap in orders was more than we'd seen in the prior 4 years, just to put that in perspective. So we definitely brought forward, it was such an excessive move. It really brought forward certainly demand we were going to have in the economy over the next few years and spent it in the last. And indeed, we are seeing, as I say, a moderating in that trend, because clearly you can't increase your consumer good orders 40% a year. There wouldn't be enough of anything to provide for that type of demand. So we've seen this downturn, and that coincides with industrial production, which we've seen roll over in the world since about March. So at the same time, we have this flotilla of ships and every kind of barge and anything available has been trying to get supply from where it's manufactured in places like Asia and elsewhere to the shores of major consumption centers like North America. And in the past few months, there's been an increasing amount of ships that have made their way over but are waiting to unload. So there's been some backup because, as I say, this order jump really created this huge amount of supply in the works. At first, there was not enough to meet the demand, and everyone gets on a waiting list, and everyone gets in the sense of putting in orders for a year from now because they presume that this will never end. But what ends up happening is, just as demand is rolling over, the supply is finally arriving and ramping up. And so this week we saw a deal struck with the 40% of the imports that come in to America come in through two ports in California, and they typically were only working during the day and not on weekends. And because of the backlog, something like 83 vessels now sitting waiting to, just floating out in the water for days on end, weeks on end, waiting to get into berth and unload. So you have something like 83 ships. The last time I checked, there was 70, so there's even more there now. And some 66 actually in berths in these ports that they're now working on unloading. And so they just didn't have enough manpower or person power to do that. So they struck a deal to say that they would now work 24/7 round the clock. And the union, everybody's on board now. And then the private transport companies, the UPS and FedEx and all these have also come into that plan. So now we've got this massive moonshot to get goods off of ships and onto transport vehicles like trucks and trains to move them across the continent. And I think that it'll take still some time to actually get them physically dispersed, but I believe that this is a sign that the supply is now going to start overwhelming the new orders, which we're already seeing. And then once inventories get rebuilt, you see, then there's going to be a decline again in just further decline in new orders. And so I think that will be price suppressing eventually, and that will be a good thing, but it also suggests that these high prices are probably incenting oversupply, which will, create a glut and then some liquidation selling again at some point in perhaps 2022.
They've complained about a shortage of truck drivers. Why would I want to be a truck driver when I keep hearing stories that I'm going to be replaced by a robot in 3 to 6 years?
Yeah, well, I think people are more immediate often in their income needs than that type of rhetoric. Like, potentially you're right if you have to train for something and you have the opportunity to wait and do that. But I think that there's a lot of people that have immediate income gains and don't forget needs that would incent them to go back to work. And I say that because we've already seen the emergency benefits coming to an end in many states in America. And that, of course, is potentially happening on the 22nd of October here in Canada as well, if it's not extended. And, of course, once the emergency benefits come off, we have seen an increase in people looking for work or taking job postings. Now, not as much as you'd think. In the States, it has not nearly been one for one in terms of, emergency benefits ending and then people getting employment. But we are seeing that there's less unemployment claims going on right now. And some people are taking that as a sign of, great, like, economic recovery. I think there's also another way to look at it, which is, of course, we've had a downturn in employment claims because the emergency benefits have ended and people just don't have the option to continue to collect. But that doesn't mean they've necessarily found themselves gainfully employed. And some of the sectors, like the hospitality industry, the restaurant industry, is still very much in crisis. I was writing about that this week on the blog. Again, those were some of the lower paying jobs available in the economy, and they were revealed as being very high risk, both to one's health during the pandemic, but also just because of shutdowns and the interruption of income that happened. And so a lot of the major restaurant chains, because they tend to be very capital intensive and, lots of upfront and very tight margins, they have already been going bankrupt during this period. So I think there's a disruption, again, notwithstanding that more than 72% of Canadians are fully vaccinated. I was just saying how, I went out with some friends a couple of weeks ago for dinner to a place that was bustling beforehand, and everybody had to show their proof of vaccination and whatnot, and you get in and you realize there's a handful of tables in a place that would normally have been packed on a Saturday night. So I just think there's a lot of pockets of gap still here. Industrial production in America, for example, the aggregate U.S. industrial production is still lower today than 2014. So I think we've been in this, we had a very low economic growth rate before the pandemic. We had this anomalous year where everything went through the roof for all these various reasons. But I think we would be probably wrong to presume that this is a new demand supercycle or sustainable or demand, indeed a supercycle in commodities starting again, because again, high prices incented production and ramping up of supply, and I think that that's going to slow as well. We see the U.S. dollar index is still holding around 94, even with the sell-off in the last couple of weeks, which is about 5% higher than it was in January. And the other end of the teeter-totter is, of course, the commodity sector. So with the U.S. dollar, there's a lot of talk about taper and how the Federal Reserve is likely to taper in November. I'm a little more skeptical because I think things are weaker than people will expect. But even if they're trying to, quote, save face and begin to taper their asset buying, the reality is that the U.S. dollar and Treasury yields typically, the U.S. dollar rises and Treasury yields typically turn lower again as soon as the Fed starts the taper. And the reason for that is the economy underlying the fundamentals are, there's a lot of imbalances and weakness, which cheap money can paper over for a while, but as soon as they stop injecting excessive liquidity, the trend rate of the economy rolls over and businesses, start laying off people again, and then you see them go back to trying to inject more liquidity before too long. So I think we're in a perfect storm of difficulties coming into 2022, and I just think that capital risks here, if you look at all the valuation measures, all the sentiment measures, I think the really euphoric sentiment with SPACs and cryptomania and all that was really peaking in the spring has really come off of late. And I think that's also a sign that the market cycle may have at long last topped out again.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.